Let's get going. It's 11 o'clock. So my guest this week is going to be Mark Shepherd of Manchester and London. Obviously, but before we get there, a bit of news. So Chrysalis from this morning and yesterday, Pantheon International, and then the Henderson European merger. So Chrysalis first. I mean, really, it's about this share price move yesterday. As of about 9:30, the discount was about 46%, and the market cap's about 452 million. Now, this is all about WeFox. So when we go back to what they said about it in the annual report, everything seemed to be going okay, really. So we're talking about AI. They put a little bit more money in to help it to move towards profitability. But there was a clear roadmap of how to get there, and they did make some progress. And 23 was looking much better than 2022. And as that turned out into some revenue, we can see that actually was quite good. And they were getting more kind of partners working with them to distribute insurance. But there was also this potential upside to actually sell the software, which is something that they're doing with Starling as well. So basically, you create an engine that drives insurance businesses, and you can sell it to somebody else. But they did highlight the new management team, and there's been quite a lot of changes on that front over the past 6 months or so. So the one that they mentioned, HR officer, a new CFO, new chairman. Since then, that chairman has replaced the previous sort of founder of the business, and who's kind of a non-executive president. And the chairman, the guy Mark Carthew, is actually running the business now. In the quarterly report that Chris has put out on 2nd of May, they obviously wrote down the value quite substantially, and we talked about that at the time. And they talked about why they'd done it, and they talked about listed multiples falling, time elapsed since they last had a big funding round, and then lastly, strategic repositioning within the business. To be fair to us, I don't think we picked up that bottom one was the most significant factor in that. So apologies to that. To you, because I think we sort of lent more on the listed peer multiple group, but that's not what we picked up from that statement. So yesterday, Sky News put out a story. They got hold of an internal memo that had been sent to shareholders earlier in May, and it was quite sort of scary, really, and basically saying, if we don't do anything, we're going to be insolvent. We've got to get on and fix things. I mean, part of this may just be this chap Mark taking on the reins and getting to grips with it and trying to inject a kind of sense of urgency into everybody to say that they've got to do this. They are being quite radical in what they're doing, though. So I think they just sort of streamlining it, and that maybe was behind the change of leadership role within WeFox. That they wanted somebody in there who was going to focus on profitability rather than on growing the whole thing generally. What Chrysalis has said is that they've been talking to the managers and the shareholders for a number of months, and I think this is the main point, really, that this is not a surprise to them. They have been obviously working on this for a long time, and they stress there's a route to insurance successful outcome for WeFox Chrysalis investment. And there has been a bit of money injected, of which Chrysalis has contributed 3 million euros to prop the thing up for a while longer. So the share price has kind of rallied on the back of that. And I do think, it does seem to be that people have been reassured by this after the big fall. Obviously, we're still down on where we were a couple of days ago. Even if you had a total write-off, and I'm not saying that's going to happen, I think that the Chrysalis team are trying quite hard to say that isn't going to happen. But even if you had a total write-off, there's still plenty of NAV there to justify the current share price. And obviously, if we talked about before, when they put out the complete statement, there are things going on, things like GraphCore and Starling and Klarna, that could transform the amount of cash that Chrysalis has got and give it a lot more options in terms of what it does in terms of narrowing that discount. So I still think it's a positive story, but obviously this is not been helpful. Pantheon. This obviously is a trust that's traded on a big discount for a very long time. And then last year, they came out and said they were going to do a £200 million buyback, and the discount narrowed. But there's been some. It's not come. It's coming a bit, but it hasn't come in enough probably. So the trend is in the right direction, but we're still a lot wider than we were, back to 21, 22. So of that 200 million, they've spent 190 almost so far. What they're going to do is think about what happens to the capital that flows off the business. So things that they don't need to kind of meet the ongoing needs of the business and cover the expenses and that sort of stuff. So as that cash comes off, they're going to think, well, should we invest it in new investments or should we buy back stock instead? And they come the sort of metric that says if the discounts are more than 50%, then almost all of that cash flow is going to be used for buybacks. Well, at least sort of 3/4 of it. And then, it sort of scales back down. But the board's got quite a lot of discretion over how this works in practice. So they could say, we're going to be more aggressive than this, or they could say, we'll back stock below 20%. So we'll see what happens. But I think it's really useful to get the kind of framework and that commitment to doing something about the discount and to acknowledging that buying their own stock back is actually quite a good way of enhancing returns for shareholders at these kind of levels. Lastly, Henderson. So if you go back to the show that we did on the 15th of March, we talk about the merger proposal between the two funds. And that looked like a done deal, really. I mean, I think everybody seemed to be quite happy about it. And there were quite a number of shareholders that said at the time they were going to sign up for this. But in the meantime, somebody else came along and said to your Henderson Eurotrust, oh, why don't you combine with us instead? Which is quite a bold move, I thought, really. It's not the sort of thing they used to have in the sector at all. The board obviously gave that serious thought because not only did they engage with that party, they also went back and renegotiated the merger terms. So there are a number of things about this. The first thing is that there's going to be a much bigger cash exit opportunity, and that's for both funds. So we'll have to wait and see how much is that taken up. But obviously, 5% felt a bit low at the time. There's now kind of like a fixed commitment from Jonas Henderson to how much it's going to contribute towards the cost of the deal. It was slightly woollier before, but basically I'm not sure they're spending an awful lot more money, but nevertheless they've clarified exactly how much. And they've also cut the fee again, because it was already cut when they announced the merger proposal, and that saves about another 125 grand a year, which obviously a good tick in the box. And then the last thing they've done is to say that we will think about do shareholders need another kind of liquidity event after 3 years. So there's already a performance triggered tender offer in 5 years' time if they don't beat a benchmark. But ahead of that, even if the discount's too wide, they will think about is there a way of sorting that out with maybe a set tender offer or enhanced buyback scheme or something. We'll have to wait and see what that is. But this is all good ticks in the box, really. Welcome, I think. So that's it from me.